announcement of its financial collapse set the stage for an unprecedented financial crisis. And still, as the government is working out plans of a financial bailout, we're all waiting to see if the next shoe is going to drop or what that shoe is going to be. Many folks have been wondering how we got here, and other folks are asking, how could we let this happen? So here to talk to us about that today is Joe Biegel. Joe is a financial advisor with Park Avenue Securities in Rybrook. Joe, thanks for joining us today.
Thanks for having me.
Well, let's start out with the question of the day. Could you describe to us how we got into this situation for the average person, the average business person? What led up to this?
I think it's a combination of both objective and subjective factors. And the objective factors, things like extensions of credit to people and entities that perhaps were not so prudent in hindsight, that were dependent on a variety of things continuing to come true, so unemployment staying low, credit staying readily available, the home price appreciation continuing as it has in the past 5 to 10 years. When some or all of those things started to crumble, that led to sort of the ripple effect of an uncertainty about, well, where is the future going to lead, what other shoes are going to drop, but then led to sort of the subjective part of the analysis, where people started to think, well, am I confident that that same entity has the wherewithal to repay me? Will I lend them more money? And obviously the lifeblood of most of these institutions that we're talking about is the continued access to capital. When that became questionable, things started, the house of cards started falling apart. Take Fannie Mae and Freddie Mac, for example. They are huge institutions, but they have a huge amount of capital. They have a huge amount of assets that capital supports, but most of those assets are pretty high quality assets. But people looked at that book of assets saying, well, yeah, it's good, but is it going to be good enough to sustain the amount of capital that's there for it? And maybe it's not. So the willingness of people to continue to lend money to Fannie Mae and Freddie Mac, which supports them, was put in question. Obviously equity holders were uncertain about where they would stand in all of that. So it became almost a self-fulfilling prophecy in terms of the combination of the objective, substantive reasons as well as the subjective factors.
And the last couple of weeks, not even each day, it was like almost every hour, I'm watching as something else was unfolding. And, was this it, was this it, was this it? Now, how long do you think this is going to last? Have we seen the worst of it?
If I knew, I wouldn't be sitting here. I'd be on some island having made that prediction and making a lot of money. But
okay, but will it get worse before it gets better?
Will it get worse before it gets better? Seriously, obviously hard to know. In our business, we talk about the past not being any indicator of the future, but really all we have to go by is what's happened in the past. And the past tells us that there's a lot of volatility in the markets, a lot of ups and downs, that if you're playing this game, that's what you have to be expecting to happen. So for instance, going back to the beginning to the early 2000s, you had 3 years in a row where the S&P 500 is a sort of a measure of big U.S. companies, was down minus 9% in one year, minus 12 the next, minus 22 the next. Then the following year, which would have been 2003, I guess, up 28%, then the next year up 11%. So a wild ride, wilder than we've experienced so far. The S&P 500, as of today, roughly about down 20% for the year. So not a great scenario, obviously, but just a snapshot in time. So the cure, the remedy depends on a variety of those factors that I was describing before, turning around, so an increase in confidence in people's ability, willingness to lend, the government's plan, as we see that it plays out, to provide more liquidity to the market probably will help in that respect. The reduction in the price of oil may help in that respect as well. There's some other fundamentals that need to turn around in terms of real wage growth, sort of after inflation adjusted wage growth needs to pick back up. Some more commodity price stabilization would be good. Unemployment stabilizing, going down would be very helpful in that respect. And then probably at the core of it all, what started it all, is home prices finding a bottom somewhere and being able to then rebound from that. But having said, those are all probably the factors. When each or all of those things occur, very hard to tell. Personally, I hope we've all suffered through a lot of pain. Hasn't it been enough, and aren't we due for a turnaround? But that's partly wishful thinking.